Now, Marc Faber, publisher of the Gloom, Boom, and Doom Report, joins us on the phone to talk a little bit about what happened. And, Marc, it appears that there were erroneous trades, so a lot of this massive plunge that we saw today could have been due to the so-called fat finger. But as Julie points out, you know, this all happened right as we saw the violence really escalate in Greece. And Mark Graham from Southwest Securities, who follows the Greece situation very closely, points out that violence is a game changer. How much do you think this has to do with it?
Well, I don't think that Greece is the cause of the sell-off. I believe it's a catalyst, but the cause of the sell-off is that the markets ran up too much, too quickly. In other words, most emerging markets were up more than 100% from the March 2009 lows, and the S&P was up more than 80%. And as I have argued, we would see a 20% to 30% correction this year anyway. Now, it just happened that this 20% correction happened within 10 days. We made a low today at 1,060 on the S&P. The low on February 5th of this year was 1,045, and then we rallied to 1,220, and now we dropped and closed at 1,128. So I think that the market was overbought, ahead of itself, and due for a correction anyway. And then the computer programs, as the market started to go down, they had to change their positions from being long to short, and that then triggered the big sell-off.
Mark, what's going to happen between now and when the Asian markets open, and then, you know, when we see the opening bell ring across Europe and here in the U.S.? What has to change overnight that could make this perhaps a less brutal open than some are predicting?
Well, I think in Asia will go down today. The question is by how much, because the Asian markets were not as overbought as the S&P. The Hang Seng Index was, before the sell-off began, below the November highs, and the Shanghai Index was below the November highs and below the August 2009 highs. So in many Asian markets, we were actually already down on the year and not up like the S&P. So maybe the decline won't be as brutal. And also, I would argue that as of today's low, the S&P became about as oversold as it was after the crash in '87, from where we had a substantial rebound.
Mark,
I mean, the wheels just set in motion here because you're going to see a lot of margin calls, people point out. And this could be another problem for the open tomorrow, opens, I should say, plural, tomorrow around the world. I mean, does this just start the motion here for a continued correction, in your opinion?
Well, first of all, I think what this decline over the last 10 days suggests is that maybe we've made a major high in the latter part of April of this year, and that we will from here on have a more meaningful decline, and maybe the 1,220 on the S&P was the high for the year. It's premature to say it was, but it could be. So maybe on rallies, investors should consider reducing their positions. Secondly, what we've had today is a market, as you pointed out, where some stocks became zero just like this. That is going to happen to the entire financial system in the world. Sooner or later, the governments are all bankrupt. They can only survive by printing money, and they'll print money and print money. That's why the price of gold was up today when everything else was down.
There were so many who were listening into that ECB decision today, not on what they were going to do with rates, but what they were going to say about willingness in terms of what they would purchase, how they would purchase it, get rid of some of the rotten debt out there. Do you foresee the ECB putting any more liquidity into the system here, the way the Fed did in the U.S.?
Yes, I think they will do, because there are no easy other alternatives. And in democracies, the option of taking the easy solution over the right solution has always prevailed.
What do you expect the ECB to do here? Because the market clearly was disappointed with Jean-Claude Trichet's statement this morning, not even the discussion of massive quantitative easing, as was rumored last night. I mean, is the market going to force the ECB's hand, or is that unlikely?
Well, I'm not an expert, and I can't read the mind of the ECB members. But I think they'll bail out the system for the time being and then deal with the consequences later on.
All right, Mark.
All right.
Thank you so much for joining us. Marc Faber, their editor of Gloom, Boom, and Doom, joining us to talk about the massive sell-off that we had today. A 1,000-point drop at one point, the biggest that we've seen since the crash of '87 when Margaret and I were still in diapers.